Okay.
Okay, let's go.
Okay. Good morning to everyone. I'm Yumna Gata, and today myself and my colleague John Yamunda will be giving you a lesson on derivatives, which is the next section in investment management. And we look forward to the lesson today. And to get started, I actually just wanted to do some motivational or contribute to your emotional intelligence with the following analogy. So last week we didn't have a class because I went for a motivational workshop, and we spoke about just dealing with issues in your life, right, as a general. So she described it as people handle challenges in life very differently, right? So she says, imagine, she says she can't believe anywhere here in South Africa we don't have something called a smoke alarm in the house. So because we don't have it here, I just want to explain to you what it is. So in America, every room in the house has to have a smoke alarm installed. It's a law. So basically, it's an alarm, and you put it in each room, you install it in each room, and it's battery operated. And when it detects any form of smoke or heat, the alarm rings, and it makes a very annoying sound until, because it needs to alert you that, you know what, there's smoke somewhere in the house. So I want to ask you guys, because this is what she asked us, is that what do you do when the smoke alarm goes off in your house? And if you can please put for me your option in the chat so we can see what do you do. Now, suddenly you're sitting down in your living room or you in your kitchen and you hear this alarm going on. What do you do? Do you say, oh my word, it's the smoke alarm, let me run? Do you say, oh no, this sounds annoying? You go and, you just switch it off? Or you go and you investigate, where is the smoke coming from? Or before you even do anything, you heard the alarm, you call the fire brigade. What is it that you do so we can understand how do people deal with the smoke alarm going off in your house? Okay, so I'm getting a few threes, but I see Angel says she is going to run, right?
She says she'll get an extra fire extinguisher.
Yeah.
Finishing plan. Just go and
he's
just take it out.
He's going to sort this out himself, right? So I didn't give the option, but if you're with Ozzy, you can just put that. He's going to sort this out.
Disempowered.
Yeah. Okay, so I'm glad that most of you said 3, because that's very good. What you go and do is you go and you look, where is the smoke coming from? And you see now, is it just a false alarm, or it's never a false alarm, or is it something that you can sort out gradually? Or if you go and you see, oh no, you know what, this looks quite dangerous, then you go, you contact the fire brigade. So this is our lives as well, right? When you hear the smoke alarm going off, there's something is wrong, something is not right. What do? You go and you take time, investigate, where is this negative feeling coming from, right? Once you found the negative feeling, sometimes you don't easily find it. It can't be easily found because the room you're trying to get into where the smoke is coming from, the door is locked. So that's like a barrier. So take time to breaking down the barrier, and if you need help, you have to get help to break down the barrier. But you start with step one. You go, you look for the smoke, you try and put the smoke out if it's manageable yourself, but you go through the barriers of it to try and sort this problem out. But you never remove the batteries and say, you know what, it's an annoying sound, I'm just going to remove, I'm just going to ignore it, because what will happen? Your house will burn down. The problem will become bigger and bigger and bigger, and your house will burn down. If you run away from it, you will be safe, but your whole house will burn down. You will burn down, right? So my motivational analogy today is, think of how you will handle this situation, handle yourself in that way there. Take your time, break down each barrier, and then if you need to look for help, you go and you look for help. Like then you call the fire brigade. So even now with your studies, right? Go and see which area you're struggling with. Go and investigate, see, go deep in and see which area is really troubling you, because we are close to October. October is exam season, right? And don't just say, before you go and investigate, you're calling your tutor or you're calling another person to give you tuition, or it's not going to be as helpful if you miss this investigation step. So go through the step process, go and investigate. When it comes to your investment management, you go and investigate. You say the smoke alarm is going off in this subject. I'm not feeling very comfortable with it. Go find out which section is really troubling you, right? Go read through, try all the steps we've given you online to get through the section. If you are still struggling, you come, John and I, the fire brigade, we will come, we will help you to put the smoke alarm out. You just have to call on us. Don't be afraid to call for help, and because sometimes you need it. And treat all aspects of your life like this. When you feel that bit of anxiety going off inside of you, don't let it just go off and run and run and run. Go and investigate. If it's difficult to get to the problem, slowly break down the barriers and then call for help if needed. So that's my motivation to you today, and I hope that helps you going forward. Now, let's get, maybe after this section, some of your smoke alarms will go off. And
you think they are going to be scared when you talk about derivatives?
Yeah. This is not my favorite section. So, but yeah, John is good with this derivatives, but it's not too bad. The level at which we are here today, that we are tested on in investment management, it's very manageable. It's very interesting.
But it's challenging, Yumna. When I saw derivatives, I was confused. That's the truth of the matter. First time I saw derivatives, I was so confused.
Definitely.
But maybe I wasn't one of the cleverest.
No, myself as well. And it took me, it takes time. Give yourself time and try and single out each section and understand it well. And you'll notice, even if you don't work at it, or if you come back to it after a while, you might also feel a little bit confused, but just calm down, go through the steps again, and then you'll get it right. So derivatives is very confusing to understand, so, but here we are giving you a nice lesson. If you watch the videos we posted on my Unisa, they were excellent in explaining derivatives to you so that you get a real life experience. So you get a real live experience of what we are actually speaking about. So that will really contribute to better understanding of, I think at least we got a good turnout here, that we can mute someone here.
No, I muted them, don't worry.
Okay, thank you. So yeah, so let's get started so we can cover as much as we can during this lesson, right? So what is a derivative? A derivative is a tool used to manage risks on assets, right? So we spoke about in the very first lesson. So this is like a build-up that the more risk you take, the better return you generally get, right? So, but you can get risk and return. You must be willing to take a risk to get a higher return, right? So now you want to take the risk, but you don't really want to lose out completely. So you invest in a derivative, which can be used to manage and ensure that the investment is profitable, that you don't lose out completely, right? So that's what a derivative is. So, but we need to completely understand how derivatives work to maximize potentials, right? So you can't just go and take out a derivative if you don't understand, because you have to choose the right one and you have to monitor it so that you don't create further risk for yourself, right? Then after derivatives was used to mitigate risk, it also became a potential investment, right? So derivatives are used to reduce risk, but if not managed well, they create risk. Okay, so let's stop there, then I'll speak about it being an asset. Okay, so derivatives are used to reduce risk, but if they're not managed well, they create risk. So we can go to the next slide. Okay, so to understand things better, right? So here we have a picture of a mom, and this is her firstborn child, and she's been buying shares for her child's education, right? The child is starting school next year. What would be her concern? If you can please put for me your answer in the chat now. This woman needs to save a solid amount of money. She can't afford to lose anything. She is investing in shares. So what would be her concern when investing in shares? She might get a really good return and be able to pay for her child's education, but what should her concern be? If you can put for me an answer
this
in
is,
the
This is
chat.
a modern mom, Yumna. This is
Yes.
a really modern mom. And I think that mom is doing investments.
Yes, definitely. But now she needs to come to derivative section.
And yes, that mom is learned about derivatives. So
yes,
let's see what
so you give
what
us
they
the
are going
answer.
to
What
say.
is she going to do? What is she going to do to secure her investment, right?
Because next year the child is starting school. What would be a concern, ladies and gentlemen? Put it in the chat. Okay. Ozzy said something. Okay,
so Ozzy says.
Okay, let me go and look for people to write for you. Okay. Angel Nene. I can't see anything. Is there anything there, Yumna, in the chat?
No, it's just
no, nothing. What is she doing there? Gladys Chilon. Please put something in the chat. This is a real practical question.
What would be her concern?
What would they concern?
What should she be worried about by investing in shares and her child is starting school next year? She needs
it's a practical concern. And remember, the only silly question is the one which you don't put in the chat. Put your thoughts there. If you want to appear very clever, then you're in the wrong place. Write something and then we chat from there. Esther, put something in the chat. Okay, there's someone I'm looking for. I'm looking for someone, and I hope she
wants to fund her child's school.
Opa, what's happening?
She's concerned by investing in shares.
Did she put something? Did Opa say something, Yumna?
Oprah, no. Oprah hasn't put.
What did the last time? Did you shout it here? Because last time she was quick to put something.
Okay, yeah, we got a good answer from Ruan.
Okay. Okay. What about Pumza? Is there anything from Pumza?
Nothing from, yes, Pumza is there. She said she will start, what is her concern, Pumza? She will start saving money, yes.
She is okay. Then at least Melissa, is there anything from Melissa?
The growth, no, nothing from Melissa.
Nothing. What about from Mr. Nesengani, KB?
No, we got from Gift, we got from Moletsi.
What about Opa? Still nothing.
Nothing. Refilwe.
I don't know. What about Yonela?
No, nothing.
Okay. Let's see. How many people do we have, Yumna?
Okay, so we got a good amount of.
Okay, good. So we can
Right.
continue.
So, and everybody is on the right track. So, her concern would be basically how to manage the risk on these shares so she doesn't lose out any money, because now she needs the money to pay for the child's education. So, shares are generally a more higher risk investment, and this mom needs this money to pay for school education, right? So it's a very important it's a very important investment she's taking out. So her concern will be how can she manage the risk on this investment so that she doesn't lose out and she earns as much as she can to be able to pay for this education, right? So that's what the derivative is going to help her do, is to secure this investment and potentially gain the best out of it so that she can pay for her child's education, right?
Ruan is a perfect answer there, Yumna. You didn't even read Ruan's answer there.
Yes, I like Ruan's answer. Let me read it to you guys. Will her investment be enough? And if so, what can she do to protect her investment against market fluctuations? That's excellent, Ruan.
That's perfect. That's the real concern. Let's see someone else. Find school for good schools. Okay. No, that's not a financial concern.
Yeah.
TK, if the growth will be enough to cover cost, no, not really. Concerned about how risky. Yes, gift also has it on the button.
Yes.
Email, the main concern would be if the investment will pay enough for it. Yes, to an extent, yes, Imelda, yes, to an extent. Kutso, at what rate will her investment grow? Okay, okay. It's a worry, but when she's worrying now, she's about to disinvest. Availability of funds, interest rates, and when she starts saving. Okay.
Yes.
Her concern probably be the fact that the investment might not yield good returns. Okay. Esther says if the returns from the investment will be enough for her, okay. Will the investment be enough for a child's education, Melissa? Okay, but Ruan has it on the button. Worried that the share price will fall while she's holding on to shares and she wants to disinvest and pay the school fees. Over to you, Yumna.
Okay, so basically she wants to know how to protect her investment against market fluctuations, right? So that's what we are doing here in derivatives, is protecting our risky investments, right? So we can go, right? So now just some important terminology and definitions. So what is a derivative? A derivative is an asset. It's a financial asset, but its value is derived from another financial asset, right? So like how we spoke about in the video about cows, that's your asset. So you take out a derivative on the asset against the fluctuation of the price of the cow due to it getting sick or due to its price going up and down, right? What do we use derivatives for? We spoke about it in the previous slide. To manage the risk, to protect. It's an insurance basically on your investment, right? And some people just generally, there is a market for derivatives, so they speculate. They buy and sell the derivative to try and make a profit, right? So we'll be looking at that going into the next few slides. They make a profit with arbitrage, buying and selling in different markets, and the value of derivatives also move up and down. So the value of derivatives move up and down, which also give you an opportunity to make a profit. Okay.
Do you want to show the video, Yumna? 4 minutes, the 4 minutes video.
I think I want to move on, John.
You want to move? Okay.
Yeah, so this video is on my UNISA. So please have a look at it. It would be good if you did it before this. You'll understand it better. But even if you didn't, please go have a look at it straight after the lesson, so the lesson makes sense to you, right? So certain terms you'll come across when dealing with derivatives, right? Hedging. I'll say, how do you hedge against this? So hedging means risk reduction. How do you reduce the risk, right? Speculation, right? Assuming significant risk when trading, right? So speculating is assuming significant risk when trading. Short selling, is selling the security you don't own, right? So you're selling short, you don't own the security, but you're selling it in hope of making a profit. Then you will go and buy it. You have opportunity to buy it and sell it. A long position is holding the asset, expecting the value to increase, right? So that's also another strategy which people do, is they buy and they hold because they have they feel like this investment will increase in value, but it will just take time, right? And the types of derivatives we will be covering today are futures or forwards, options, and swaps are covered in your section, but we won't be doing it in the class today. It's a simple question which you can manage on your own, and you can ask us for any help online.
And what I can also do, Yumna, is I'll put I have a few slides on swaps and the video. I'll put the, I think, 4 slides in addition to the slides we're going to share with them.
Okay, that'll be great. So basically, like like we try and cover the sections which you need help in, and the sections which are going to help you to get a good result in investment management.
So we are only covering the difficult stuff, ladies, and that our focus is to cover the difficult stuff. Some of the things we will never have enough time to cover them.
Yes. So like, if I can just break away from here, like, I don't know if many of you are wondering why haven't we done spot rates on bonds. Is because it can take us like 1.5 hours to explain to you spot rates on bonds, and like generally you might get one question on spot rates in the exam. So we rather cover a few sections which can get you get you a better result in the exam, and then we will leave spot rates online with videos, slides, and practice questions, and thereafter when we're preparing for the exam we can cover it in a shorter time then.
But actually, we don't skip it completely, because if you go into my UNISA, you will find videos, 5-minute videos, which explain all these things slowly.
Yes, and then you listen to the video a few times over, and while doing a question, and that can result in a better understanding of that.
And if you don't understand the video, you can still send a message on the platform, and then we can respond there. So in short, we can't cover everything in a lecture, but we will cover as much as we can.
Okay. All right. So what is a futures contract, right? It's exchange traded and it's a standardized contract. So that means there's a specific market where these futures contracts are traded on specific assets, right? So it's like a market which you can find on online on the JSE. It's a futures market, right? And then we have a commitment to buy an underlying asset at a future date at a certain price. So what is a future contract? A futures contract is you need to buy an asset at a future date, right? But you're worried about the price fluctuating, that is getting too high in this case here. So what you do, you enter in a futures contract. So you're locking the price today that you're going to pay in the future. Am I still online here?
Yes, we can hear you, Yumna. Sorry. Can hear you. I was just on mute.
All right. Sorry, John, can we just go to the previous slide? Sorry. So that's what a future is. Risk exposure is when you enter into this contract, you mitigate the risk, right? You lock in your position now and the price is going to be paid, and you are saved from any negative fluctuations in the market, right? So that's what a futures contract is. And then we can go to the next slide. Okay, so futures and forwards, there's a slight difference, right? A forward is an agreement by parties to buy and sell assets in the future at a specific price. So it's more of a tailor-made contract, a forward, right? Where two parties entered into a private agreement. Whereas futures, it's the same concept, but it's exchange traded. It's traded on the big market. It's a standardized contract which you can enter into. So here's a nice example which John has done, which explains to you how this works, right? So we have Tando here, and she has some Capitec shares, right? And she's so worried that the price of the Capitec share will fall and she lose all her money, right? So what she does, she sells a forward contract on my Capitec share. Now, when she needs the money, she's selling a forward contract to sell it at a certain price in the future date. Then we have Tumi, and Tumi is saying Capitec is doing great, and she believes the share price is going to rise. So she doesn't want to pay a high price when it's time for her to. She doesn't want to pay a high price when it's time for her to invest. So what she does is she buys a forward contract. She's going to take over Tando's shares at the price which Tando has set it for to sell in the future, because Tando doesn't want to lose out and Tumi doesn't want to pay too much. So this is a forward agreement. It's tailor-made between Tando and Tumi, and it works out. It's a mutual agreement between them. It works out for both of them. Tumi doesn't want to pay too much because she thinks Capitec's going to go high, and Tando, she thinks it's going to fall. So she wants to lock in her price today. So it's quite simple, and it's understandable. So now this is how we calculate futures prices, right? There's a formula for calculating futures price where your future is equal to your spot rate times by 1 plus the interest rate to the power of your time to maturity, right? So you need to know this formula by heart, very simple, and this is how you calculate it, right? A 10-month future contract is entered into with the share price being 100 Rand. The risk-free rate is 10% per annum. What is the futures price? So here we are calculating a theoretical futures price, right? So we say 100 Rand times by 1.10 to the power 10 over 12, right? So my advice to you is that I say solve for 10 over 12. 10 over 12 gives you 0, and then you say 1.1 to the power of 0, 10 divided by 12, right? And then you times it by 100 and you will get your answer, right? So if everybody...
There's a question in the chat, Yumna, from Oz, who says, "What are there different types of futures?"
No, I think they all are the same, John. What is the answer?
There are different types in the sense that they are futures on shares, they are futures on commodities, and different shares have different futures. So there are all sorts of different types of futures.
Okay, but they all work in the same way,
in
right?
a similar way, in a similar way. So there's also a futures on forex, and yeah, so there are different types of futures, if that is the question.
Yeah, futures on forex is the most popular.
Yeah, it's the most popular. It's the most, because people want to import stuff.
Yeah, like, you know, once we go down to options, you get different types of options. But on the futures...
Or maybe, a question maybe was European and American futures. They all operate similarly.
Yeah, that's on the options. But on the futures, I don't think that there's a difference, you know?
No, there's no difference. They all operate, because remember, they are trying to trade for time. Okay. I added this slide because I thought arbitrage would be difficult to explain in the next when we are doing the calculation.
Okay, all right. So basically what arbitrage is buying and selling in different markets to make a profit, right? So what happens is, if you look at this table here, right, we have USD to Rand, the rate offered by Nedbank versus the rate offered by FNB, right? So basically you can buy for 16 Rand 90 at Nedbank, right? And you can sell on the FNB at 17 Rand, right? So basically you're making a 10 cents profit, because both the banks, sometimes in the market, there's the slight difference, and what people do, they exploit this difference. They'll invest large amounts of money. So just say you invest 1 million Rand and you buy USD in Nedbank and you sell it on FNB, you say 10 cents, your 1 million Rand times by 10 cents, you can generate a very good profit, right? Easy money in that way.
And it's a riskless profit. That's called arbitrage. That's what is the arbitrage. To say it's riskless. And if you see this situation, ladies and gentlemen, please phone me quickly so that we can all get rich at the same time.
John got his million rand ready, everyone. So
No. I'll build up. So I'll buy 10,000, and when I make more money, then I'll keep on investing, and we are going to be rich, Yumna. When you see this situation, but arbitrage, ladies and gentlemen, it's a riskless profits.
Yeah.
This is unlikely to happen in one market, but there are more complex. So Yumna is going to explain a more complicated way of exploiting arbitrage using futures and forwards.
Yes. So basically, you get two types of arbitrage, right? So above we calculated your theoretical futures price, right? But that's not what the price it sells for on the market. So you'll calculate the theoretical futures price based on risk-free interest rates, right? And the market quotes a different price. They sell the futures at a different price. If what the market is selling it at is different from the price you calculated on your formula above, there's an opportunity for arbitrage, right? So in the case where the market quotes a price which is greater than the theoretical futures price, what do, right? What you do is you sell the futures price quoted at the market, right? You sell the futures price quoted at the market. You sell it, so you're going to deliver this in the future, right? You have to deliver the underlying future price that you locked in today, right? So you're going to sell it. Then now you need to have this asset to deliver it in the future. So you have to go and borrow money, right? You borrow money at the risk-free rate and you buy the asset to deliver it in the future, right? And you take the money that you borrowed, you buy the asset at spot, right, at the current spot rate to deliver it in the future. So what will happen is that the money you have to pay back to the bank is going to be less than what the person who bought it from you, the person who buys the futures from you. So you subtract the two amounts and that's the profit you'll make, because the price the futures is selling at is higher than how much you're going to pay the bank for the loan, right? So the best way to explain this is with an example, right? But that's called cash and carry arbitrage, right? So here's an example, right? Or I'm going to give you the opportunity to calculate the theoretical futures price, and then we can decide if there's an arbitrage opportunity, right? So we have Jake Gray here, who believes he has identified an arbitrage opportunity for a commodity in the table given below. So the spot price of the commodity is 120 Rand, the futures price expiring in 1 year. This is the price that they're selling the futures at. The 1 year interest rate is 8%. Please calculate for me and put in the chat what the theoretical futures price will be. Above we have included the formula so that you can easily calculate it. And then underneath your answer, tell me if you can if there's an opportunity for arbitrage. So when will there be an opportunity? If the price quoted for the future is different from the price that you are calculating now, the theoretical futures price.
You know, Miyumna, when I was doing my undergrad, we never spent too much time on the arbitrage.
Oh, you spent too much time.
We spent a lot of time on calculating the futures price and to say what is the value of the future before maturity.
Oh, okay.
But so I can see the module is slightly shifted.
Okay. So you would be calculating your spot, like your spot futures price.
So they will tell you when it was bought, it was there, but in between, see if it is accrued any value in between when the spot price has changed.
Is it? I've never calculated something like that, eh?
I calculated that. I did that when I was doing my honors, and it was so confusing. It was so confusing to me.
Why? Okay, but we never did arbitrage. We just learned the
Yes.
terminology, the concept of it, of how people would benefit from arbitrage, and that what generally happens in an arbitrage situation is that
Yes.
once people take advantage of the arbitrage opportunity, the markets start to stabilize and the prices go back to the correct values where you can't make a profit.
When I heard the word arbitrage, when I was doing my investments, I started to think these opportunities are so many, huh?
Yeah. So have you
Ah,
invested?
no.
Yeah.
No. There are not so many. Especially where once you factor in the costs of doing the transaction, no money.
Yes.
No
That's
money.
Yeah, like even myself, like I would try and put my savings, which is always like as a woman, it's very difficult to save. Our expenditure is very high. So, but the little that I would save, I decided to open up a share account, and my husband would be like, everything you earn is going to go into costs because the costs are so high. Opening
Because
up, you're gonna have to save more, but that didn't motivate me. I just closed up the account after paying so much of costs to
to do the transaction. But did you?
Yes, to do the
transaction.
transaction.
I can see we have
But
some
like my husband.
Let's see how many people we have. Ladies and gentlemen, we are just
Yes,
talking
yes,
because we are just waiting for you. So we are having a good time just chatting.
Yes, we're chatting our personal investment experience.
Yes. Okay. In 2020, okay. Now I think I want to know what you did. Did you buy shares in 2020?
No. I didn't buy.
You didn't.
Like, no. I have, John. I'm dependent, but and like I told you, like I'm in like my husband and I, we manage our finances together, but
Yeah.
he is now the investor, so but he missed out on the opportunity because of fear, like
But you were there trying. You were there in investment guru. Why were you letting him being afraid?
Yeah, no, he doesn't trust what I have to say. So, but you know what? This is like the story of our lives, like he always
But you don't
like
act.
no, I'll say to him, buy low, sell high.
Yes, 100%.
When it's like low, he's so afraid of, but it's just his luck. He'll always invest and then it will fall further and he can't handle that feeling,
Oh, then he cashes.
Yeah, and so 1, 2 times he even cashed in. So yeah, and then what happened was we actually invested in our first business at the time. So he actually sold out. We actually were at a disadvantage because I remember he had a nice portfolio, but he invested in for quite some time, but he needed the money to invest in this business. So then we sold out to pay for that business, like in between there, yeah.
Okay.
So, but he tried, yeah, we tried, but
Okay, let's move on. Let's see. We have 11 responses. Should we move on?
Yes, we can move on.
Yeah, and I think they got the answer right, most of them.
Yes, so that's the correct answer. So now, what are we looking at this? What are we seeing here, right? On the market, they selling the futures for 125 Rand. Theoretically, we calculated that it's supposed to be selling for 129 Rand 60. So here we have the opportunity for arbitrage. Yes, there's an opportunity, right? So let's look at what is happening. Your price is less than your theoretical futures price, right? So here we have the opportunity for, I think it's cash and carry, reverse cash and carry arbitrage.
There's a longer explanation here.
Okay, so let's look at this explanation, right? So what you will do is, now this futures contract is cheap, right? It's cheap because it's supposed to be selling for 129 Rand 60, right? But it's selling for 125 Rand. So what we do is we buy the futures contract, right? So we buy it, we borrow and we sell the asset, right? We borrow money and we sell the asset, right, in the future. we invest, we sell the asset spot, we invest this 120 Rand that we're getting now, right? We invest it at 8%, we're going to get 129 Rand 60 after we invest, right? Then at maturity, you're going to sell the future for 125 Rand. So basically, you are going to make a profit of 129 Rand 60 less 125, which is 4 Rand. Just see.
60.
4 Rand 60, right? So this is how you have to exploit the arbitrage. It's a few step process because it requires you to borrow and invest. And you will earn 129 Rand, then you sell for 125 Rand, and that's how you make 4 Rand 9 profit, right? So basically based on the difference, whichever is higher or lower, there's a different step process, right? So you have reverse cash and carry arbitrage. This is the opposite of what has happened up there, right? So here your futures price will be greater than your theoretical price. So in this case here, you buy the futures contract, right? So that you can buy the asset, you can buy the asset in the future at a price set today. Sell the underlying at spot, invest the proceeds until expiry, right? So this is when your futures, theoretical futures price is greater than your spot price. Sorry, this is exactly what happened up there. Your theoretical futures price is greater than your spot price. So here's a question for you. We have Luke Thomas believes he has identified an arbitrage opportunity by information given in the table below. The spot price is 130 Rand. The futures is selling. The futures price P is the 100 Rand. And interest rates are 6%, right? The theoretical futures price can be calculated as follows. Okay. So please calculate the theoretical futures price and tell us how you will exploit this arbitrage opportunity.
So this time we are going to say buy spot, sell future, or buy future, sell spot, invest.
Yeah, cash and carry arbitrage is when your theoretical futures price is less than your price selling on the market. And your reverse cash and carry arbitrage is when your futures price is, no, am I saying it wrong? Wait, let me tell you properly what it is. When your futures price is, your theoretical futures price is greater than the spot futures price, then your price quoted, then you have reverse cash and carry arbitrage. When it's the other way, you have cash and carry arbitrage.
Yumna, while the ladies and gents are doing calculation, can I ask you to open your slides from that side? Your power is there with that side.
Can I open my slides on? Okay.
Not share, you just open them because at 10 I'm scheduled to have load shedding.
Yeah, I see the stage 5. We're on stage 5 load shedding.
We are on stage 5.
Yeah, they said stage 5 starts at 10 o'clock. So if we all go offline at 10 o'clock, you guys must know why.
Okay, so you're also going. Okay, so so what I'll do, you know what? Let me power up my iPad. And what else can I do as a backup? Because we still have 15 minutes. Let me make sure that the slides are on my iPad.
Okay.
So that we can continue.
Yeah, I'll also continue from my cell phone because I doubt I'm not going to have power on the desktop. I have a laptop, but if you're sorting out your iPad, then I won't open up my laptop.
Look at here now. She's
I'll put it all on you. Then we know the class will continue. I'll speak the rest of options.
We are just planning, ladies and gentlemen. I'm hoping you are doing your calculations there while you are planning for load shedding.
Okay, but either way, I'm going to do it because hopefully my load shedding would be over. I just want to check what is it saying. Oh no.
It's not over.
No, it never started, but I got a notification that it's it's supposed to be till 12:30, but I'm sure by 10 o'clock it's going to kick in here.
Yeah, okay, but let's see. Let me do this. I'm going to my. Did you receive the slides I sent you earlier on?
Yes. I'm just downloading it and keeping it online.
Yes, we are. Look at me opening the wrong thing. I'm doing the wrong thing. Download, and let me make sure that I'm off my fiber. Okay, we have to work with it like this. And let me go on to. There's no answer there, Yumna. What's happening?
Oh, I'm not even monitoring here.
Okay, now Yonella's posted something. I was getting worried that everyone is worrying about load shedding.
Okay. Yes. It looks like now you have to invest. Apart from shares, you're going to put your money in a backup system for your
backup system. It's just a shame that I haven't done that. I haven't spent a decent amount of money to give myself power for at least 2 hours.
Yeah, 2 hours. But like the quotations that I get, it's expensive, John, and like this new business we opened up, like to run the generator.
Oh, like generator! It's noisy.
Oh my!
It looks like there's a question there, Yumna. There's a question, Yumna. There's a question. Kamokelo, you are ready to talk? You can speak.
Good morning, everyone. So I'm getting my calculations correct. Like in this example, I'm also getting 137.80. However, I'm not sure as to how to go about explaining how would I then exploit the arbitrage opportunity.
Yes, that's what Yumna. Okay, you see Sendo there. Sendo just showed you how we are going to do it. Buy the contract.
Okay, thank you.
Okay. Yeah. You can carry on. We are just chatting while these other people are working.
Yeah, but it's just there's 2 options for this: cash and carry arbitrage, reverse cash and carry arbitrage.
Yeah, those are the only 2 options.
Yeah, so you don't have to stress about it. You get the theoretical price, and then you decide based on the fact that it's selling at this price on the market, and I calculated theoretically for it to be here. Is the difference, you look at which difference it is, and then you follow those steps to exploit the arbitrage.
I think we have lots of responses. Should we continue? I think let's have 1, 2, 3, 4, 5, 6, 7, 8, 9. We have 10 responses. 10 out of 23. Are you happy to continue?
Okay, yes.
Okay, let's continue. Okay.
Okay, so the solution is option 3, which most of you have got. So let's see how you calculate it. Is your futures, your spot price times by your interest rate, which gives you 137.80, right? Now, what do you do with that, right? So here it's like very detailed. It tells you exactly your theoretical futures price, right, is greater than your market price. It's quoted on the market for 100 Rand, right? So we do reverse cash and carry arbitrage, right? What do? Is you sell spot, and if you invest the proceeds, you will receive 137 Rand 80, and you buy the futures, right? Because now you're going to buy at 100 Rand, which is a very good price, right? So this is how you make your profit with reverse cash and carry arbitrage, right? So here we have Refilwe asking a question.
Yes, everywhere you can shoot.
You can go.
I just experienced load shedding, so the electricity came back. So I have a problem with responding to my answers, giving you answers to the question. So I don't want you to think that I'm not participating in the group.
Oh, but did you get 137.80?
Yes, I got 137.8.
And did you say reverse cash and carry?
No, you know, I'm trying
You
to
see, you were supposed to say yes. That's what I said.
I know, I can't lie.
No.
Thank
you for
you.
being honest. Okay. So we have two slides which I put up here for reverse cash and carry arbitrage and cash and carry arbitrage. So go have a look at those slides, and when your futures price and your theoretical futures price are different in terms of those slides, those are the steps that you follow, right? So here in reverse cash and carry arbitrage, we sell in the spot, we take the money, we invest it, we'll end up getting this 137.80, and we buy the futures cheap for 100 Rand, right?
Any questions, ladies and gentlemen? Because now we are going to go to options. I don't see anyone asking a question. Any questions, ladies and gentlemen? Because now we are transitioning to options. Do you hear anything, Yumna?
No, nothing, John. Refilwe, you can put your hand down. I think you're okay. But I don't see any questions on the chat.
Nothing, okay. Oh, okay, now there are two questions.
So we have a question.
Yonela.
Yes.
Good morning, everyone.
Yes,
I just wanted to just confirm with this formula, because it's F into brackets 1 plus R into time. So if you're not given time, do we always assume it's 1?
Usually are given time, we are given months or year.
It's always going to give you. Yeah, but generally we putting this because this is the first time, or not the first time, but this is how we're training you to start calculating. But the questions that we upload can generally have a 10-month or a 6-month. Then on the top where you see T to the power of, then it's going to be 6/12. Then you're going to say to the power of 0.5, and that's how you'll get the answer. So that will give you a lot of practice questions. There is practice questions on my UNISA with the tutorial. I'll try and upload more so that you can, once you've perfected this calculation, you can go on to those.
Okay, thank you so much.
Okay, let's go to options. Okay, that's thank you for putting my photo up, Yumna. Where did you find my photo? That's exactly my photo.
That's exactly Jordan. So it took me so long to find a happy guy online.
Oh, to find. Okay, ladies and gentlemen, I'm expecting my power to go off in about 5 minutes, but by that time I should be organized. I will change my slides and start sharing on the laptop, not on the side screen. But when we are talking of options, it's also another form of derivative. I always want to say right, but no obligation. Because remember when Yumna was talking about futures and forwards, she was saying at maturity, you are supposed to exercise the future. So if you're in a futures contract, you are obliged at maturity to do something, buy the asset or sell the asset. But in an option contract, we say an option gives you the right, but not an obligation to transact. But you only transact if you are the holder, you have the right, no obligation. You only transact when the terms are favorable to you. But for the terms to be favorable to you, you have to pay a premium. Okay. So we have two types of options. We have what we call put options and call options. Okay, I want us all to be on put options in our minds. Put options is easy to explain. So put option gives the holder the right but no obligation to sell it doesn't make sense, don't worry. We have Rose here. Rose owns ShopRite shares. And she is worried that the share price will fall. But she's saying, if I do that futures, which Yumna was talking about, that complicated futures, what if prices increase? So the current ShopRite shares are at 40 Rand. So she's saying, I'm worried that if it falls, then I'll lose money. But I don't want to sell the futures to sell my shares if the price rises, which makes sense. But for that, I will pay a premium. So we are saying then she goes, buys an option contract. The price of the option contract is 2 rands. That's the cost of it. And she agrees with the underwriter or option, I think we'll call that person an underwriter, to say if the price is at 38, that's the agreed price. So they are going to evaluate that option at 38 Rand, which is called also a strike price. So remember, this is a put option and Rose owns their shares. So let's say at maturity, what would be Rose's decision if the price of the shares are 39 rands? Is she going to exercise the option or not? Let's put it in the chart. If the price falls to 39 rands, is Rose going to exercise the put option? Her right to sell at the agreed price. I hope I'm making sense, because I think I'm expecting to see responses quickly, because it's yes, she will exercise, or no, she won't. So yes or no, yes or no. Option, question 1. If the price at the end is 39 rands, is she going to exercise the price? Because remember, the agreed price is 38. The premium is 2 rands, and what is the decision for us? Yes or no? If you are not sure, you just say yes or no, whatever. You can't say whatever. You can say yes or no. Ladies and gentlemen, this is no calculation. You just have to say yes or no.
So we got a lot of no's.
Okay, a lot of no's, lots of no's. Yes, that's good, that's good, that's good. Okay, so ladies and gentlemen, if you say no, 100%, you are on the ball. Now, number 2, ladies and gentlemen. Same contract, but now the end price. What is the decision? If the ending price is 35 rands, is she going to exercise? Now we are supposed to say number 2, so that we know that you're answering number 2. Yes or no? If the ending price is 35 rand, is she going to exercise her put option, a right to sell? Number 2. Number 2, yes. Number 2, no. Number 2, yes. Number 2, no. Let's put in the chat. Number 2, yes. Number 2, no. Number 2, yes. Number 2, no. 2 yes, 2 no. 2 yes, 2 no. Ladies and gentlemen, if you said no, that's not correct. But the answer is yes. Why? Because if she exercises her option, she can sell her shares to the underwriter at 38 rands. If she doesn't exercise her option, she will have to sell her shares at 35 rands, which is at a bigger loss. So she will exercise the option to sell at 38 rands because the market price is 35 rands. Ladies and gentlemen, options are confusing. They were confusing when I was still in school. Okay. Now, ladies and gentlemen, I want to take it a step further. So we are all agreeing now to say, yes, she will exercise at 35. Now the question is, what is her profit if she exercises the option at 35? Is it 3 rand? Yes, load shedding decided to start, so I have to reorganize. Yumna, can you still hear me?
I can hear you, John. Yes.
Yeah, I jumped onto my other network. I jumped on, so I'm trying to reorganize my laptop. I am trying to connect my laptop to my dongle.
In the meantime, we're getting some answers. You know, I'm actually glad that everyone wrote for the second answer no, because then at least when you correct it, you'll remember it. Because this is a put option to sell. We want to protect ourselves from the price dropping. And now, even now when we're doing the profit, how much profit will she make? A lot of, we're getting a good response here, and then John will respond and explain to you how we calculate.
Yes, now you can still see my slides. Okay, now I think I am. The only problem is now I don't have insurance. I don't like living without insurance. So now all my gadgets are now sitting on the same network. But we will survive. Okay. Okay, let me see the answers. What were the answers there? Are they correct?
So we have a 3 Rand and 1 Rand. So,
ladies and gentlemen, okay, let's see. 3 Rand. But there are too few people, Yumna. The people, let's give them time.
Yeah, let's
What is the profit, ladies and gentlemen? What is the profit? If she sold her shares, we agreed she's going to exercise the option. So she exercised the option and she gets 38 rands. And the market is there. What is the profit? Don't say, I did not do anything. Put your answer. I want you to commit to an answer so that when we explain, you are saying, okay, I'm brilliant or I got lost. I think we're brilliant people there, Yumna. What do you think?
So,
yeah, we are starting to see some brilliant answers coming through. Okay, now we have lots of responses. Ladies and gentlemen, if you said 3 Rand, sorry, I am so sorry. It's wrong. You forgot one thing. Remember, for the right but no obligation, you pay a premium, and that premium is 2 Rand. So you would have to say 38 minus 35, 3. Okay, but you forgot. Small forgetting. Forgiven. But next slide, if you forget, I will not forgive. So 3 Rand minus 2, the premium, what gives you 1 Rand? Ladies and gentlemen, we are now talking about a call option. Call option is similar. Right, but not obligation. But this time, instead of selling, it's a right to buy. So when you look at a put option, think about you holding the investment. That lady was holding the shares. That Rose lady was holding the shares. But now we have Renee. Renee is saying ShopRite is great, is doing great, but their share price is going to increase. That's what Renee is thinking. And I think their share price is going to, I also think their share price is going to increase. Even personally, in reality, I think their share price is going to, they are doing great stuff. I was reading the news of last Sunday. I only read the news on Sunday. Last Sunday, they are opening more branches. I think about almost 200 branches. I'm saying, wow. But like Renee, we say, okay, they are doing great stuff. Their share price might increase or might not. Okay. So what does Renee do? Renee buys a call option and doesn't buy the share because she's expecting the price to increase. And for that right, she pays a premium of 2 Rands. Okay, now comes your question. Ladies and gentlemen, what is the decision for Renee if the ending price is 37 Rand 50? Is she going to exercise the option or not? Now let's put in the chat. Yes, no, yes, no, yes, no. For number 1, 37 Rand 50. Renee exercise a call option. Yes, no, yes, no. Let's put in the chat. Yes, no, yes, no, yes, no. Say something. Say something. Okay? Yumna, while we are waiting for these guys to think of yes or no. In 2020, A friend came to me and said, you know what, all mutual share is at a huge discount. Buy it.
Yes. Great decision.
I went and bought very few shares.
Yeah.
My fear was losing money. I don't know why I was afraid. I went and bought old mutual shares, a few, maybe I think less, about 900 rands. Then I bought a few from Nedbank, I think another about 1,000 rands. And I said, okay, let's see what is going to happen. Oh, Yumna, I was supposed to put all my money there.
Yes.
I was supposed to put all my money there. Now the value of those shares, two of them, 3,200.
Wow, that's great. Sure.
But you can imagine if I put in, let's say, 50,000.
Yes.
I wouldn't be teaching.
Yeah. Luckily, we still have you, John, so it's fine. Luckily, you put your 900. Now everyone's going to pass investment management.
Now I'm still teaching. Look at me now. Ladies and gentlemen, yes or no? I can only see 1, 2, 3, 4, 5, 6. Don't listen to me and Yumna. Me and Yumna are just having a good time. And you guys are supposed to be working hard. Yumna and me, we finished with this module. We finished wrestling with it.
You know, when I just got married to my husband, like I was getting to know him, and he's a very risk-averse guy, you know, and won't take any risk. So, like, you know, when he told me he had invested on the market, and you know, his father, like they always, so his father gave him the permission to invest, and between him and his cousin, they saw these derivatives, you know, like these derivatives.
Very clever things.
Yeah, and you know, I was like, I literally turned my head. I said, "You invested in derivatives," but he didn't know at the time what. He just said, "Oh, this is easy money. We can make money," and he lost so much of money. I said, like, he invested. First of all, he shouldn't be investing in shares.
In the proper share. Our derivatives is not easy money.
When he invested in derivatives.
You don't play with those things. Derivatives you don't play with. Okay, ladies and gentlemen.
Yeah.
You don't play with derivatives. It's too complicated. Okay, ladies and gentlemen, if you said yes, sorry, very sorry. The answer is no. Because if she buys at 37.50, at 37.50 it's not to any advantage, because remember she will have to, the agreed price is 38. Remember, she's betting on the price going up. So the price should be above that 38 because it's a call option, a right to buy. Okay, ladies and gentlemen. So she will go, if your decision is to say she goes and buys this from the under at 38. In the market, she can only sell it at 37. Then she's buying herself a loss. Okay. This time forgiven. Number 2, ladies and gentlemen, number 2, no forgiveness given. Number 2, what is the decision for Renee if ending price is 45 rand? Number 2, so you say 2 yes or no. 2 yes or no. If you are too fast, like some people might, like Yonela there. Yonela, once you say number 2 no or number 2 yes, then calculate the profit here. Okay? But first say number 2 yes, number 2 no, then calculate the profit. Like Kutso, calculate the profit or loss. Okay. So you said you asked, didn't you try your hand on derivatives, Yumna?
Didn't I?
Didn't you also try to invest in derivatives?
No, I will never invest in derivatives. No, I couldn't even, like, I would, and you know, like, I'm very specific as well, because like, you know, like, when religiously we believe you mustn't invest in, like, you can't invest in companies that are not, like, you know, which are interest bearing, like banks and things like that.
Or you can invest in banks.
Yeah,
Also, you can invest in the, like, what is it called?
Commodities.
Beer, alcohol.
Alcohol, you can't invest in all, like, even insurance is not permissible, although lots of we do have, yeah, but insurance is also not like a, I'm not so I can't give you the details why, but it's not like a very, because it's like it's all interest bearing investments.
Yeah, of course, of course,
So
of course.
yes,
Then because the insurance, then they are into those bonds and all those things.
yeah, so you're not like allowed to invest in all of those. So for me, what I did was like generally when we get married, then people gift you like money, you know, they'll give you, instead of buying your tangible gifts, they'll give you money. So I took all that money and then I invested in like unit trust. That's like the only share that I have.
Yeah, that's
but it hasn't like done well. Yeah, but at least I haven't lost out. So like there's a manager managing the fund,
you didn't do the
and
derivatives.
No.
Ladies and gentlemen, Yonela, go and calculate the profit. That's what we are talking while we are waiting for you to calculate the profit or loss. Profit or loss. Ladies and gentlemen, okay, let me tell them, okay, what is the decision? The decision is yes. Yes, Renee should exercise the call option because the price 45 is above the strike price. So yes, number 2 is yes. Now, ladies and gentlemen, go, and now that we know that it's yes, go and calculate your profit there. Okay. So you are invested in in a unit trust.
In a unit trust, yeah. But the value just stayed stable. I haven't rechecked it now, but it like actually for at one stage it even lost out a little bit. But yeah, but at least it stayed stable. But now my next investment, but I'll probably do something a little bit similar, is like for even when you get I have 2 daughters, so I haven't invested any of their gifts. So that would be my next lump sum investment, but I'm not sure in what to put it, you know. So I was thinking of like you know, maybe with one of the banks, because now they have all these Sharia compliant sections. I was thinking of maybe with FNB, but also in something like this, you know, hopefully to grow their money for them. Hello? Did we lose John there? Or did we lose me?
Looks like we lost John.
We lost John. Okay.
Yeah.
All right. Hopefully he'll be back online. In the meantime, you guys can put your answers in the chat. Okay, if John doesn't get back, then I will try and share the slides and we can look at the answer. Yonela, 7 Rand loss. Yes, okay, so I think John has fallen off. Okay, so let me try and share this. here. Okay, so basically what is Renee's profit or loss? So what is the decision for Renee if the ending price is 45 Rand, right? So she has the call option to sell at the agreed price is 38 Rand, right? So currently she has the option to buy at 38 Rand. Currently the price is 45 Rand. So she will exercise the option and buy at 38 Rand. So it's costed her 38 Rand plus the premium of, just want to get my pointer out. So plus the premium of 2 Rand. So basically she is now buying at 40 Rand when the ending price was 45 Rand. In the market it's 45 Rand. So she can make a profit of 5 Rand, right? So well done to those who got it, and very good for those who answered. And we can.
Can you hear me now, Yumna?
Yes, I can hear you now. Hey, I shared the slides, John. You did this.
Yeah, thank you very much.
You did this.
Thank you very much.
Okay. All right. Great. So, yes, let's.
I don't know whether how prepared you are, Yumna. Things just happen.
Yeah, no, definitely.
Okay, let's go to the next slide, though.
Okay. So this was.
No, let's skip the video because we don't have time anymore.
Okay. So here's the next slide, John. You can go ahead.
Okay, thank you very much, Yumna, for holding fort. So there are two types of. Who was asking that question? There are two types of options. So we said there are put and call options, but there are two general categories. There are what we call American options. Remember we said you buy an option when the period starts and you exercise it at the end, at maturity. So that would be a European option. If you are obliged to, if you can exercise it at any time, that would be an American option. So an American option, a European option, the moment you have to wait for maturity, sorry. For an European option, you have to wait for maturity to exercise it. An American option, you are looking at the price every day. Once it is advantageous, it's profitable to you, you can exercise it. Then the strike price or the exercise price is the agreed price. To say we are going to transact at this price, that's the strike price or agreed price. Okay. Then let's talk about volatility. Oh, nice. Volatility. It's a popular term which you hear if you listen to finance news often. Volatility. Up and down. The changing in price. Not when the price go up and down, up and down, up and down. That's volatility. That instability in price. That's volatility. So we say options are valuable when the market is very volatile or there's high volatility. Then option premium, we spoke about that. Let's go to the next slide, Yumna. Okay, yes, now this is a payoff diagram. A payoff diagram for a call option. So remember, call options you exercise when you are expecting the price to increase. So we are saying, now I don't have the pointer. Nice. Okay. So we are saying before the strike price, as the price increases, you get to strike price. That's where you have a break even. Okay, I'm sorry. You get to strike price. That's when you start to exercise it. Then you get to where the price, the spot price meets where premium is cleared. That's a break even point. Where your profit is basically zero, that's break-even point. Then when prices keep on increasing, if you're an option holder, your profit keeps on increasing. So we say your profit is unlimited if you are an option holder. As long as the price keeps on increasing beyond the strike price, you keep on increasing your profit. Let's go to the next slide, Yumna. So in a similar payoff diagram, but for a put option, remember we're expecting the price to fall. Similarly, but you can say, as long as your price is still above the break-even point, the strike price, you don't exercise it. Below the strike price, you exercise it. And then when the profit is zero, that is the break-even point. Any price below the break-even point is profit. So the maximum profit you can make in a put option is the difference between the break-even point and zero. So we are saying if you agreed to, let's say your agreed price, you are holding this FNB share, which is selling at 20 Rand, and your agreed is 18. Anything below 18 is profitable. So your maximum profit is that 18 and 0. Between those, that's our maximum profit. Let's go to the next slide. We have 7 minutes. That's good. Yumna, we have a question actually. That's a good thing. I am a farmer and I'm worried that the price of beef will fall in a year's time when I want to sell my cattle. Therefore, option 1, I will buy myself a put option. I will buy myself a call option.
Very good.
So you can say 1 or 2, or so that you don't type too much. Make your choice, ladies and gents. Make your choice. Go. You can just say put option or call option. Put option or call option. People are tired, I think. Okay, two. Okay, yeah. Now I'm seeing some people say something.
Precious call option, but put option. Sure.
Yeah, call. Lerato call option. Put option or call option, ladies and gentlemen. Put option or call option. Call option, put option. Let's wait for 2-3 more people, and then we are in Rafilwe. Was she the one who said she was load shedding?
Load shedding, yes.
Rafilwe, what's your answer there? So you can talk now. Now that you can talk, the load shedding doesn't close you off from talking. Maybe Rafilwe actually do. Oh, nice. Okay, so you buy yourself a put option. Why would you buy a put option? Because you are worried the price. You are in farmer number 1. So you are worried the price of beef will fall, which is two things. You are a farmer, so you have your cattle or your beef. You rear cattle, you don't rear beef. You rear cattle, so you have your cattle. You are worried the price will fall. So you buy yourself a put option, which gives you the right to sell at a specific price, but not obligation. Let's go to the next slide. Let's see what's next. Okay, another question. That's good. Ladies and gentlemen, if you get this one right, Yumna, we can call it a day and celebrate.
Okay.
I will give you alcohol, champagne. Alex has bought a put option for 5 Rand and the strike price is 55. At maturity, the spot price of the share is 49. Calculate the profit or loss of the put option holder. What is the corresponding profit or loss of the writer? Similar to what we were doing there, but before. But what we were doing before, I was taking you step by step. Okay, now this one you can do it on your own. While I'm going to ask Yumna something. So would you agree to hold an alcohol champagne, Yumna?
To hold it?
Yeah, to just holding it before, because I can't ask you to drink it before you hold it.
No, I won't.
Alcohol free.
Alcohol free.
Yeah, we call it alcohol free champagne. There's this the champagne with no alcohol.
You're sure? Not 1% also?
Nah, nothing.
Checked behind the bottle. I'm very strict, John.
It looks like you're too strict.
Too strict, yeah. But for those of you who are answering, John said he's sending alcohol. So if you get the right answer,
yes,
you must
okay.
be
No, I'm sending Yumna alcohol-less champagne. And in that same box, to just make it a little bit exciting, I will also send alcohol Savannah. You know, this is a cider called Savannah.
Yeah.
So since you shouldn't do any alcohol, I will do champagne alcoholless, zero alcohol. Then I would put a Savannah there.
Okay. Don't think about sending that to me.
And your husband is the one who's going to receive the gift. You know, what's happening to my wife?
Yeah, he'll still.
Then you say, don't worry, it's John. John promised it's no, there's no alcohol.
I don't even have anyone to gift it to.
Okay. Oh, people are getting 11 rand, 11 rand, 11 rand loss. Ruan, what is the corresponding profit or loss to the writer? Since you already have the holders, the loss there. Okay. Let's go to the next slide because I'm looking at my time and I'm seeing time is jealous. Okay. Ladies and gentlemen, so we are saying the decision here is to exercise the put option. Why is he exercising the put option? Because the strike price is 59 and the spot price is 49. Okay, strike price is 55. So we say 55 minus 49 gives you 6 rand. 6 rand minus 5, 1. I don't know how people got 11 there.
I also want to just find out where did we get 11, because a put option is the option to sell. You want to? Yeah.
And 11, actually 11, I am a little bit at a loss there. Or maybe they say 55 minus 49, 6 plus 5.
Yes.
Okay, now I think I will retrace. We see I did a poor job. You and I did a poor job. I didn't emphasize enough right, but no obligation.
Yeah.
So the maximum loss the holder can ever have is 5 rand. Because if it's not advantageous to him, he will not exercise a right, but not obligation. Any questions before we close the recording? Because I'm looking at the time now, it's 10:29 and we were promising that it's going to be 10:30 sharp. Ruan says we use the spot minus strike.
It comes back.
Oh, then you added the 5, Ruan.
Yeah.
Yes, Yumna.
No, I said this, you know, the options, it comes back to a word problem. You have to read the scenario, not just put your numbers in, because a put option, understand what is it. It's an option to sell. You want to lock the price to sell at a higher price in case prices drop. So you got to understand the terminology, and you know, you got don't just look at the numbers. Look at the entire question.
Yes. Okay. Sendel, there's a good end up there. Sendel, if you can talk.
Hi, how are you?
Good.
I just wanted to know, are you gonna put up more exercises for these options? Because yay, it is flames galore here for me.
We are stingy, Yumna. We are not going to share anything. Where it's going to be a sick.
I need all the practice I can get, please.
Okay, but I haven't uploaded any more questions because no one has responded to my, I think in the
yes,
about 10 questions. Oh. So no one has told me except for Oprah.
People are actually snubbing us. We don't know what we've done. We've done.
Yeah, you know, the first to next lot of questions is doing the first lot. And if a small respond like, you know what, I've done them, please upload more, or have a look, I've done them, or help me with this answer, or bring